Ladies and gentlemen, I am Jerem Timkulu. I welcome you to this presentation where I will be taking you through question Centipede from the ACCA past exam question for the December 2016 exam sitting. Okay, in this presentation, I'm going to elaborate how students were supposed to have attacked this question, and I hope after listening to this video you would be assisted when it comes to the exam technique, as well as in mastering the concepts of audit risk, acceptance, engagement acceptance procedures, and some part of ethics. Okay, some ethical considerations when there is a situation where conflict of interest arises. Okay, so by the end of the video, I hope you would have benefited from this question. Okay, as part of your preparation. Some of you are writing exams in this coming March. Okay, in March, that is next week, you'll be writing the March 2022 exam, and I hope you are going to be helped. And those who are still studying, I hope you also benefit, because by June or September you would have mastered a lot of things with regards to audit risk, engagement acceptance, as well as some ethical considerations in the cases where conflict of interest has resulted, okay, or is potentially going to result. So that's all about this question Centipede. Like I said, it is from an ACCA, that is Association of Chartered Certified Accountants, past exam question for the December 2016 exam. So those who want to find the original copy, you may go to the ACCA website or request them for the question itself, or you may obtain this question from various exam kits like the BPP, Learning Media publications for the Audit and Assurance exam, as well as the ACCA Kaplan, the Kaplan Publishing Limited. They also offer those exam kits to ACCA students, and various professional qualifications. They do that on a lot. Okay, without wasting your time, please, if you find this video helpful, don't forget to subscribe, as well as to just give your thumbs up to show that you like it, and also just have to put your comments on the comment portion below, so that I know where I'm lacking, and as part of the staff from the Transcal Consulting Services, which offer online content, online tuition to various individuals around the globe, you may also consider yourself to be one of us, and to learn from us while studying this ACCA qualification. Okay, because we want our pool of students to continue growing. Okay, but we do not want the numbers just to grow, but to ensure that those people who have become part of us benefit from passing as early as possible. So this is why we are trying to ensure that we are known and we deliver. Okay, now this is the question Centipede. Okay, and in the exam situation, my best tip is that you need to just read the first paragraph and then go down to the question to see what the examiners want. You can see that this question is a bit different from the original question, from the original question paper, because we try to ensure that for the presentation it won't be very difficult for students, especially on the tabling. Okay, we had to do to come up with the table. It's just a modification. Okay, so that for presentation purposes, it's going to be a bit easier for us to see these figures while I'll be presenting. All right, this is just a slight deviation from the original paper. Okay, I hope you you will be helped with that modification. Okay, so this is the question. Let us just read the first paragraph and then go straight away to the question. You're an audit supervisor of Audit Co and are planning the final audit of Centipede Co, which is a listed company, for the year ended 31 December 2026. Okay, the company purchases consumer packaged goods and sells these through its website and to wholesalers. This is a new client for your firm, and your audit manager has already had a planning meeting with the finance director and has provided you with the following notes along with financial statement extracts. Okay, that's the first paragraph. Okay, let us go straight to the question. The requirement. Okay, the first requirement is that we have to describe matters which Audit Co should have considered prior to accepting the audit of Centipede. So acceptance procedures, okay, are required here. What do you have to do before you accept a client? What do you have to do before you accept a client? Prior to accepting the audit of Centipede Co. So those are the matters we need to consider. What do you have to care about? What do you have to worry about before you accept a client? And this is a knowledge-based question. If you don't know, if you don't read your, if you didn't read the approved content from those guys which I've indicated to you, like the BPP and the Kaplan and so forth, you're not going to have what is required to answer this particular question. But one thing I want to tell you is that, remember, this, when the examiner says that you are an audit senior or audit manager, do not forget that you are an audit manager from the ACCA brand. Okay, from the ACCA brand. So that's where students lose this just simple mark. Okay, if you're an ACCA member, all right, you need to abide with the ACCA Code of Ethics and Conduct. Okay, so that's one thing. That's one thing you have to raise. Okay, when the examiner asks you about these acceptance procedures for engagement, tell the examiner that, hey man, before we do anything, we have to consider ourselves not going to be in a position to violate the ACCA's Code of Ethics and Conduct by violating things like fees, okay, professional competence. Okay, we need to consider, because these things are included in the Code of Conduct and Ethics, where the court says that you have to ensure that the amount of fees you are going to obtain from this particular client is not going to be so large that you are going to have an undue reliance on the client. Okay, so this one, this question is a knowledge base, which means that yes, you may read through, but no more answers or no more tips are going to get into are going to be obtained from reading the question. But you just have to tell the examiners from the book, okay, what you have read already. If you didn't read the whole syllabus, you're going to be in fire, because the knowledge-based questions are going to be there in the exam, and you're going to fail if you didn't read enough your theory. Okay, so like I said, the first tip should be from you highlighting to the examiner that we have to ensure that we're not going to violate the ACCA's Code of Ethics and Conduct, okay, in accepting this particular engagement. For example, we have to ensure that the fees we are going to obtain are not going to be so large enough that we are going to unduly rely on Centipede alone. Okay, good. What else do we have to tell? You then have to highlight things like the competence, resources, okay, preconditions of an audit. Preconditions of an audit. Does it exist there? Okay. When we talk of the preconditions of audit, don't just tell the examiner that you have to ensure that the preconditions of an audit exist. What is that? Tell the examiner, what are you talking about? Okay. For example, does Centipede, we have to worry if Centipede follows an applicable financial reporting framework. Okay. Do they follow applicable financial reporting framework? Applicable. Okay, financial reporting, FR, financial reporting framework. When we are saying applicable, we are saying in terms of the legislation of the country in which they operate, do they abide with that financial reporting framework? Like, for example, in terms of the Companies Act in that particular country, or in terms of the IFRS or the IA, International Accounting Standards. Okay. We need also to on this particular point again highlight the management's role. I mean responsibilities. Does management we have to worry if management acknowledges its role to act as its role in or its responsibilities with regards to the preparation of financial statement. Sometimes some of these companies, when they hire auditors, they expect them to produce financial reports for them, and then they just sign the audit is fine. No, when we are going to audit you, we are going to come there and prepare your financial statements. Are we together? Now, the last thing on this precondition, that managers or the management is going to provide the auditor with all the necessary information he needs. Those are the preconditions of an audit, or for an audit to take place. Otherwise, if they are not there, then the audit should not be accepted. Are we together, ladies and gentlemen? Now we talked about the resources. Do we have enough manpower? Do we have enough finances to fund this particular audit? The vehicles required, etc. Do we have all those things? Even the audit software itself. Is our audit software strong enough to attend to the demands of this particular client? Do we have the experts to help us in doing the audit? When we talk of the auditors expert, I'm sure you know that we are not talking about guys who know accounts, but we are talking about guys who know things like IT systems, guys who know about valuation of work in progress, etc. Remember, this is a specialized company in a specialized industry. Okay, if you go back to the first paragraph, this company is listed. Okay, the company purchases consumer packaged goods and sells these through a website. This is an IT compliant company. Okay, an IT sophisticated company. It does everything online. Do we have the necessary skills? This is where we need guys from the IT gurus. We need to consider all those things. Are we together? Then we also need to consider conducting, the outgoing auditors. Okay, we need to consider conducting the outgoing auditors with the permission of the client. Okay, with the permission of the client, we should have considered, or we should consider conducting the outgoing auditors. But for what? You need to tell the examiners for the purpose of knowing why we should not accept this particular engagement. We need to know from the outgoing auditors why, or if there are any other reasons we should not accept this particular engagement. And then the last but not least, the fee itself. But the fees in relation to the risk. Okay, we need to consider the amount of risk attached to this particular audit, so that we know how much we have to charge. Because remember, the fees should be in relation to the task that is going to be done. Are we together? Yes, we need to know if the level of risk attached to this particular client is high or low, so that when we are going to charge, we are not going to charge from the blue. We charge according to what we expect to get and what risks are we supposed to face. I'm sure on this part you have obtained a lot of help, because this is a rich pool for exam questions. They are always going to ask you about what you have to do before you accept an audit engagement. Like I said, the purpose of this video is not actually to regurgitate what the examiners have written, because the answers and solutions are already online there. They are there. But I just wanted to stimulate or to provoke the pain in your mind, in your head, so that when you face a similar question, you're not going to just regurgitate facts. Because if you just regurgitate facts, there is a danger that you're going to offer wayward answers which are not compatible with the given question at the moment. Okay, so you just have to know what is actually happening, what is required. For example, or in summary, we talked about the issues to do with, you have to highlight. Okay, let me just go here, get here. Okay, doesn't matter. Okay, just a minute. Okay, acceptance. Matters to consider. Okay, just the points. Okay. No violation of the ACCA's code of ethics and conduct. Okay, preconditions of an audit exist. And you have to highlight the three issues which I pointed out. Okay, the three issues which I pointed out: the FRR reporting, the FRR reporting framework. Okay, framework, management, acknowledgement of responsibility, acknowledge, hey guy, just come this way. Okay, acknowledgement of responsibility. Then the third point, we talked about let's just come here. Just come here. Okay, preconditions of audit, follow applicable. Okay, the third one is the issue to do with access to information, access to info. Okay, management is going to provide us access to whatever information we need. Every information we need, every record we need, everything that we need as part of the audit should be available to us. Okay? Then you then have to go and talk about the issues to do with competence, resources. Okay, competence, resources, yes, and resources, they just have to be given there online. Then you have to talk about the outgoing guy, professional clearance. Okay, professional clearance. Then last, you need to talk about the fees in relation to risk. So you tell the examiners Centipede Co should consider the risk attached to this particular audit so that they know how much to charge. Okay, if the risk is too large, again, they should consider declining the engagement. If the risk cannot be reduced to a lowly acceptable level, then they should decline the engagement. But at the same time, they should also consider risk in relation to how much they should charge. Okay, I hope you have been helped in how you are going to attack these particular questions. It's very real, because if you do not worry about the fees, okay, if you do not worry about the fees, then we are going to be good auditors, but we are going to fail in the short run, because we are going to fail to pay our rentals for our offices, for our labor. Okay, we are going to fail paying our the salaries and wages of our staff. So by the end of the day, if we do not consider the fees, then we are going to fail, even if we are very bright auditors. Okay, let's move on to the next segment of the question. So you can see that these points have been raised without actually reading, because in the exam, you just have to be careful. There are some knowledge-based questions which are going to come, and those questions are going to, will be attacked not basing on the scenario itself, but based on the knowledge which you have acquired during the course of your studies. Okay, let's finish reading this paper. The scenario. Okay, as we now go, we've attacked part A. Let us now go to the next requirement so that we won't waste a lot of time going back and forth. Calculate 6 ratios for both years, which would assist you in planning the audit of Centipede Co. All right, so you can also see that this part does not require you to read everything in the scenario. Okay, you can even attack this part before reading everything. Okay, but for the purpose of our this presentation, we just want to make it as short as possible. Let us just read C again. From a review of the above information and the ratios calculated. So from the review of the information, this one, the examiner is trying to say that from the narrative, from the scenario outside the figures, because ratios are calculated from the figures in the table, but information should give you a hint that the examiner there is referring to the narratives, the narrations, okay, the scenario. describe 7 audit risks and explain the auditor's response. So we need 7 audit risks and their corresponding responses in planning the audit of Centipede Co. Are we together? Okay. Now, let us now read the question with the aim of identifying the audit risk. At the same time, we need also to calculate the ratios. So we're going to calculate the ratios last, but we need to identify the audit risk. So I think it's essential and prudent for me at this juncture to discuss with you what audit risk is, so that you may or so that we may move on the same page as we attack the question audit risk. Okay, audit risk is the risk that the auditor gives an inappropriate audit opinion. The risk that the auditor gives an inappropriate audit opinion. Remember, by the end of the audit, auditors are required to prepare an audit report. In this particular report, there is a paragraph. They express their opinion over the audited subject, and in this case over the financial statements of a business, whether it is it has been or whether they have been presented or prepared on a true and fair basis. Okay, so the auditors might come with an opinion that says that the financial statements have been prepared or have been presented in a true and fair view, okay, or are presenting a true and fair view of the operations and financial position of the companies concerned. Okay, that might be their opinion, but the danger is they might say so when in actual fact those financial statements have not been prepared in that respect. Okay, so it's either way. Okay, the examiner, the auditor could say FS are not true and fair, or FS are true and fair. If in actual fact, let's say in the first instances where the auditor says the FS, the financial statements are not true and fair, when they are true and fair, that's again an issue to do with audit risk. Okay, in that case the auditor had lied. Okay, so when we are talking of risk, we are just saying there is a possibility that when the auditor conducts his audit, he is going to come up with a wrong opinion, saying that the financial statements are going to be not true and fair, when they are in actual fact true and fair. There is also a risk that he's going to say the financial statements are true and fair, when in actual fact they are not. So that risk is the one which we are going to be examined in the exam. We're going to be examined on that risk. So our scholars, or many scholars, they believe that Audit risk has got two components. Okay, there is risk of material misstatements and risk of detection. We call it detection risk, DR. Risk of material misstatements and detection risk. In the exam, when the examiner asks you to talk about audit risk, he is just referring to this combination. Okay, they move hand in hand. Why am I saying so? If there is no detection risk, okay, if there is no detection risk, let's say this one is not there, and there's only risk of material misstatements, then there's not going to be audit risk. It means that audit risk is also not there, because even if the directors are going to put errors or to make errors in the financial statements, the auditors are going to detect the risk. They are going to detect that. So if the detection risk is not there, then whatever errors they are going to do, whatever fraud they are going to do, we are going to see it. So there is no audit risk. There's no risk that we are going to issue an inappropriate audit opinion. Now, let's say there is no wrong, but there is detection risk. We send down drunk auditors to the audit of a particular company. Those guys, they drink a lot. They're not going to do anything. They'll be just sleeping. Haven't you seen auditors coming to your workplace? What they want is just those cookies and drinks from our canteen. They do nothing. Okay? All right. So they're not going to detect anything. But luckily enough, there is no risk of material misstatements in the financial statements. The financial statements are just good. So there's not going to be any audit risk, even if we send it to auditors, because the financial statements are going to be defined as okay, they're justified. So audit risk, maybe the risk that is going to come there could be that these drunken guys might end up saying the financial statements are true and fair, but which is actually are not true and fair. But which is actually not going to happen with our drunken guys, because they want to come back tomorrow. So they are likely just to say, oh, the financial statements are good, even if they do not do anything. And they're going to be good as long as there was no risk of material misstatements in those financial statements. Okay, now let's go a step further in our analysis about these issues. Let's go a step further in our analysis of these pertinent issues. Okay. We need to know what these issues are in essence, okay, so that we won't be found wanting on exam day. Risk of material misstatement is concerned with financial statements, while its detection risk is concerned about the auditor's procedures. Auditor's procedures. Okay? This one is financial statement preparation by managers, usually is linked to what the managers have done in preparing those financial statements. They could have done some errors or make some errors, or could have done some fraud, and which means that the financial statements are misstated. Okay. Now there are two subcomponents for this. There is what is called inherent risk and control risk, and here there is what is called sampling risk, as well as non-sampling risk. Okay, when you're talking of inherent risk, this is a risk that is attached to the financial statements because of the nature of the business. For example, because we are trading in fast-paced consumer goods, for example, things to do with the cell phones. Okay, cell phones are fast-paced in the sense that they just get obsolete in as little as just 6 months. Okay, they got obsolete, and a new phone is going to come every 6 months, and these days it's almost about every 3 months there is a new iPhone, a new this and that. Okay, so there is a risk that the inventories which the client is holding is obsolete. Okay, and if it is obsolete, what it means is there is a risk that that inventory is going to be overstated. So such type of a risk is inherent. It is just common with the nature of the business in which our client is involved. Now, when we talk of control risk, we are just saying that the systems that are in place in the client are not likely to detect on a timeous basis, or timely basis, those errors or bad processes when they occur. Okay, so the client's system is not going to detect whatever error that is going to happen to the financial system when the error has been committed. So that's control risk. The client system is not that effective. Its internal control system is not so effective that it is able to detect or prevent an error when it happens on a timely basis. Sometimes to prevent or to detect or to correct that error. So client system cannot detect or correct error. Cannot detect or correct errors timeously. So if the client system is like that, then we are in a bad situation, because we are likely to have the audit risk, which is very high. Now, when we go to the detection risk, we are saying that there is a sampling risk and non-sampling risk. Sampling risk is the risk that the sample which we choose, because remember, it is not economic for auditors to check everything at a company. Sometimes the fee might end up being too high and we lose business. The client might say, we can't pay you, so it's better we look for other auditors. So by the end of the day, we will be forced to do sampling. The other factor is also about the time. Remember, the audit report should be relevant. If the audit report comes after 6 months, then it becomes irrelevant. We need an audit report at least in 3 months. Otherwise, if it comes after 1 year, then there was actually no purpose to be audited at all. So we might end up doing some sampling. But the problem is, in our sample or in our sampling, the sample or subject, the sampled subjects were not actually representative of the whole population. We might say out of 100, we inspected 40 items, 40 out of 100. But the problem is, in these 40 items which we sampled, they were actually not representative of the whole 100, or of there was an outlier somewhere in the skist things which we did not, in the skist items we did not check. There was actually an outlier, something that was, maybe the fraud was not part of the 40 items which we picked. The fraud was in the other skist. Then that risk is going to lead us to detection risk. We are not going to detect anything, because the sample we chose was not representative of the whole population. Now, when we talk of non-sampling risks, these are all other risks bedeviling the auditor. Having drunken staff, drunken masters, okay, lack of competence, lack of resources, all of those things. Because there was no resource, then the auditor is likely not to detect anything. They did not have audit software. They were just like traditional, old-fashioned village auditors. So in that state, they're going to come up with a bad audit. Sometimes they were pressured by the client. They were under time pressure. So they could not check everything because the client was pressurizing them. Then the other things, there are ethical things to consider. Okay, the issues to do with familiarity, etc. Because these guys, the auditor was actually a relative. So there was a risk that they were just flying past the audit, flying past whatever record they saw, because they didn't want to embarrass their friend. So that's non-sampling risk. I hope you have been helped with this particular background. So let us now go back to our question Centipede and talk more about these things in practice. Okay? Remember, audit risk is a function of risk of material misstatement and detection risk. And risk of material misstatement is made up of two subcomponents: inherent risk and control risk. Detection risk is also made up of two subcomponents: sampling risk and non-sampling risk. Bear this in mind as you prepare for your next imminent exam, for the ACCA Audit and Assurance exam. So let us now go back to the question Centipede. Okay. You are an audit supervisor of Audit Co and are planning the final audit of Centipede Co, which is a listed company, for the year ended 31 December 2086. The company purchases consumer packaged goods and sells these through its website and to wholesalers. This is a new client for your firm. Okay? This is a new client. And we're talking of audit risk. And I said it is a component of risk of material misstatement and detection risk. This is a new client. Don't you think there is an audit risk attached to new clients? Of course, there is. Okay? New clients impose serious audit risks in the sense that we are not accustomed to their business processes. So there is a risk that, okay, all right, let us just use a clean worksheet. Okay, audit risk, response, because remember the question wants us to come up with the audit risk and the response the auditor should give as we attack the question. Okay, so we're going to have a situation where this is a new client. Okay, these guys are new and okay, these guys are a new client. All right, so there's a new client. Or you may just write a full sentence like Centipede Co is a new client. Okay, there is, okay, all right, okay, there is a high detection risk in the sense that we would not be knowledgeable of their processes. Their business processes, and their opening balances could be misstated as we did not audit them. They were audited by the previous auditor, remember. Okay? Centipede Co is a new client. There is a risk because remember, the question is saying that listen to the verbs of the requirement. Describe. We are required to describe audit risk and the response and explain the response. So in describing the audit risk, we have to identify the risk, identify and explain. Identify the risk, then explain it. So this is why we have identified Centipede Co is a new client. Full stop. That's identification. We have identified from the scenario. Remember, if you identify from the scenario. It is there. It is actually there. And the 7, you can see that we are going to come up with the 7 risks as easy as sleeping. Okay, just as easy as sleeping. Yeah. But to some people, sleeping is not easy. But it's as easy as just a nap, getting a nap in the afternoon sunshine. Okay, Centipede Co is a new client we have identified. But let us explain how a new client is a risk. Because by the end of the day, if you just say Centipede Co is a new client and you go to the next point, you did not explain anything. Tell the examiner what risk is attached to new clients. There is a high detection risk in the sense that we would not be knowledgeable of their business processes and their opening balances could be misstated as we did not audit them. Okay, we did not audit them, or maybe in the previous year or previous periods. So what do you have to do then? It's not about just identifying and explaining the risk, but you just have to tell the examiner, what then do you do? Do you just go home and say, oh, this guy is a new client, so we can't take them? Then how are you going to expand your practice? How are you going to expand the audit firm if you don't accept new clients? You have to come up with the procedures to make sure that that risk is reduced to a lowly acceptable level. This is why you are doing this course, so that you know what you have to do when you meet new clients. You have to manage them. You have to know how to respond to whatever risk that is attached to these clients. Some risks can be prevented, can be safeguarded. And how are you going to safeguard this particular risk? Number 1, remember here, the examiner may give you 2 points because you have identified You've identified two issues here, two risks attached to a new client. There's a risk that we do not have, there is an issue of business processes, okay, of which we are not knowledgeable, as well as the issue to do with opening balances. So the examiner might be too pedantic and say you've identified two different risks, and you also have to give two responses so that you can get those marks and pocket them. Okay, let's say, how do we deal with opening balances? We have to, let's start with the business process. The business process, okay, we have to devote more time to Centipede Co, Co's Audit, Centipede Co's Audit, okay, to ensure, because don't just say we have to devote more time, and so what? More time to watch soccer? More time to do what? To go to the beach? No. So that to ensure we are conversant with their business systems, conversant with their business operations, business systems. That's one. We're done. Now let's go to the second issue here about the opening balances. We also need to send more experienced staff, to send more experienced guys. More experienced staff, so that risks attached this iPad of mine, the battery is now full. 1 minute please. Good. Okay. So that risks attached to opening balances is minimized. That's a response which is actually very, very, very competent. Okay, my machine here is misbehaving. All right, let's come up with the risk. These guys are also listed company. Okay, Centipede Co is a listed client, and we know there is an issue listed client. Centipede Co is a listed client. There is a risk management might be tempted to manipulate figures, to do what is called creative accounting. Creative accounting. so that's their business would seem healthy. And boost its share price. So this is a listed company. They want the share price to remain stable or to rise. Okay, so they may be forced to cook books. So what do you have to do? What do you have to do? As auditors, we need to devote more work on revenue recognition issues, revenue recognition, and other subjective areas like revaluations, and provisions. Why revenue recognition? We are saying that the management could play around with issues to do with cutoff periods and so forth. Okay, they might recognize revenue early before they perform the performance obligations and so forth. All right. So it's actually imperative to point to the examiners that we need to devote more work on this area of revenue recognition, because that's where managers might end up, reporting fake figures about revenue when in fact the revenue shouldn't have been recognized at that point or at that level. Okay, let's move on. Okay, let's go to the question. You have seen that in just one paragraph we have come up with two risks, okay, and which are worth 4 marks, okay, one risk and one response. Now, two risks and two responses. Let's move on to, okay, client background and notes from planning meeting. Rather than undertaking a full year inventory count, the company undertakes, let us wrap this fee thing, okay. The company undertakes monthly perpetual inventory counts, covering 1/12 of all lines monthly. As part of the interim audit, which was completed earlier in the year, the audit assistant attended a perpetual inventory count in September and noted that there were a large number of exceptions where the inventory records were consistently higher than the physical inventory in the warehouse. Now, when you hear things like perpetual inventory counts, okay, this is a situation where at least we have got an inventory count at least once, maybe in a period or in a year. Okay, at least once, which means we may do inventory counts 2 times, 3 times, 4 times, but at least once a year. Okay, it's different from having a fixed year-end inventory count. Okay, now employers do it for the purpose of safeguarding their assets and so forth, but there is a danger if the inventory, the perpetual inventory practice or session is not complete. Okay, there might be some errors in these inventory counts and so forth. All right, so such an error might lead us to have the wrong inventory count figures. I mean inventory figures. All right, so you need to highlight that point to the examiner. Let us see. Okay, the common utilizes a perpetual inventory count at its warehouse, but it is written in the question. Remember, by identifying, we're just picking things from the scenario. Okay, at its warehouses. Okay, at its warehouses. Okay, at its warehouse, rather than a full year end inventory count. All right, this, okay, this means this pen of mine, this means they they count inventories at least once, a year, and adjust discrepancies on a timely basis. Okay, there is a risk that this process is not complete. Adjustments involved, etc., they might not be complete. Okay, it might be done halfway and not to the letter. Okay, so the risk is that the information or the process itself, the recording and everything, the adjustment might not be complete. So what do we do as auditors? What do we have to do as auditors? Since we have highlighted that the risk here is the completeness of the inventory, so the response should be targeted to the completeness of the inventory records. So the completeness the completeness of the inventory count of the inventory, okay, counts should be reviewed. Okay, the completeness of the inventory count should be reviewed. Okay, for what? Okay, the completeness of the inventory count should be reviewed, and controls over the perpetual inventory count process tested. We need to test the controls, okay, such that we get assurance the process was indeed okay. We need to test the controls which were put in place to ensure that the perpetual inventory count was being done as it should have been. Okay. All right. Now, such type of a point or an odd risk as this one about the perpetual inventory might be tricky in the exam, given the exam pressure, and you may consider it for the purpose of attacking the exam. You may consider it as some of those last points you have to mention to the examiners. There are very many, there are so many odd risks in this scenario which we may attempt first given the time, because there's no point in wasting a lot of time and energy on the trick bits. Okay, so we need to go back to the question and read it again. Let's read the question. Okay. As part of the interim audit, which was completed earlier in the year, an audit assistant attended a perpetual inventory count in September and noted that there were a large number of exceptions where the inventory records were consistently higher than the physical inventory in the warehouse. When discussing these exceptions with the finance director, the assistant was informed that this had been a recurring issue all year. In addition, the audit assistant noted that there were some lines of inventory which, according to the records, were at least 90 days old. Okay, so here there are so many things which have been highlighted, or which have been discussed by the examiner, but we need to highlight or to fetch out the odd risks which are involved. Okay, the first issue has to do with the exceptions. Okay, there were a large number of exceptions where the inventory records were consistently higher than the physical inventory in the warehouse. Okay, you just have to tell the examiner as it is. Okay, there were exceptions. There were inventory exceptions noted during interim audit. During interim audit, where inventory on record was higher than on hold. The actual inventory in the warehouse was less than the one on paper. So interesting, isn't it? So interesting. Okay. Okay, as the year-end inventory figure is based on record inventory. We're not going to base with what is on the ground, but we are going to base financial statements are prepared according to what is on the primary record, okay, not on what we have on the ground. We are going to use those records. So the purpose of having auditors is to ensure that what is on the record is what is on the ground. But the issue is, in this case, what is on the ground is different from what is on the paper. Okay, so as the year-end inventory figure is based on record, on recorded inventory rather, on recorded inventory figures, there is a risk that the inventory on financial statements is overstated. So what do we have to do? What do we have to do? The first thing we have to do is to assess the significance this pen. Okay, we have to assess the significance. My battery is getting down. Sorry, put the power on. Okay, we have to assess the significance of the adjustments made to inventories. Remember, these guys, they use a perpetual inventory system where they, after every count, they make adjustments to the inventory records on a timely basis. Okay, so we now need to, because there have been some disparities between the inventory on the ground vis-a-vis the inventory on paper. Okay, so there's been some differences. So we need now to assess the significance of the adjustments which have been made to reconcile these inventories. We need to assess their significance. Okay, so what do we have to do? We then have to discuss with management. The reason behind the disparities, behind the disparities behind the disparities and the significance and their significance. This may also signal the need to have a full year end inventory count. If no tangible explanation is given. So the auditors can consider having a full year inventory count at the year end if managers are failing to justify the disparities. Okay, because it would be an issue where the controls of the company are not working as they should, especially when it comes to inventory count. All right, let's go back to the question. In addition, the audit assistant noted that there were some lines of inventory which, according to the records, were at least 90 days old. Now, when we reach here, I think it's imperative for us to calculate the ratios. Okay? We are now being taken to the issue of figures. Okay? So it's better for us to then do what we had skipped before, the issue to do with the calculation of ratios. Okay? Now, the ratios, we can just calculate them even here, but let us just use, let us try this, if it is possible. Alright, but I'm sure we can just calculate them here. Alright, what we need, we just need how many from the question? We need 6 ratios. Okay, it's fine. Let's calculate them. Okay. Let's start with the GP margin. GP margin. Okay. The GP margin. 20x6, 20x5. For the 2 years, the GP margin, okay, GP margin is just gross profit divided by revenue, okay. For year 26, can use our calculators. Okay, using our calculators, we're having, okay, I want this guy. Okay, we're having 9360, 9390. 93. What's going on here? 93. Sorry, okay, 9390 divided by 25 230. That's 37. Okay, that's 37.2%. 37.2%. Okay. Okay, just for part B here, they might just okay. Okay, ratios. GP margin. Okay, 26, 20, ox 5. All right. And we say that this is 37.2% according to our computation. Okay, 37.2, and then we have got we have got 71. Gross profit, that's 7165. Okay, 7165. Don't know what's going on with my calculator here. Don't know what's going on. Let's try to use what's going on with this calculator. Sorry. Okay, so we are saying that 7165. It's not responding again. Okay, for the purpose of our time, let me just try to use my phone here. All right, we are saying 7165 divided by 7165 divided by 21180. That's 7165 divided by 21180. That's 33.83. Okay, so that's 3.83%. Okay, then the operating expense, operating profit is operating profit margin, OP margin. Okay, the OP margin, we're going to use these figures. Okay, the operating profit was how much? Operating profit for 26 was 4487 divided by our sales, the revenue 25,230. So we are going to have we're having 17.78%. 17.78%. Then for the year 2025, we are having 3920 divided by 21180, so that's 18.51%. Okay, 18.51%. These guys are disturbing me. Okay, it's good. Okay, now we've got this one, these ratios. Let's look for the other ones which we can have, which we can add. Okay, we've got we need to calculate the receivable days, the payable days, inventory days, etc. So we need them. Okay, receivable days. Okay, we've got the receivables divided by the sales. Okay, receivables divided by the sales. Okay, our receivables, how much are they? 1590. Okay, divided by 25,230, so that's 6.3%. So the receivable, multiplied by, that's 0.036, multiplied by 365, multiplied by 365 days in a year. Just assume that the years the year has got 365 days. That's the standard. So that's 23 days. They've got 23 days here. Remember, we are talking of days, not percentages. Okay, so we are saying that receivable days is receivables divided by sales multiplied by 365 days. We go to for the 20x5, go to the question. What with the receivables? 1250 divided by the sales 21180. Okay, multiplied by 365. We are having 22 days. 22 days. Payable days, payable days. That's the payables divided by the cost of sales. Okay, payables divided by cost of sales. In 2016, how much were the payables? 3,500 divided by the cost of sales in that year, 15,840. Okay, multiplied by 365, you're having 81 days. We go to the for the 20x5, the payables were how much? 2.8. Okay, divided by payable, cost of sales that year, 14,015. Okay, multiplied by 365, we're having 73 days. Okay, we can also calculate the current ratio with its acid test ratio, the quick ratio. Okay, how many are they now? They are now 6. Okay, so we can also have the inventory days. And inventory turnover. Okay, the quick ratio, let us do the quick ratio, which is the current assets divided by current liabilities. What were our current assets? Current assets, these ones are the current assets. Okay, These are the current assets. If we add them up, get the current assets. Okay, that's the current ratio. Okay, the current ratio is called current assets over current liabilities. So the current assets in total, that's 2360 plus 1590. So we get 3950 divided by current liabilities. Okay, our current liabilities, we have got the current liabilities. These ones are the current liabilities. Okay, so the 3950 divided by this one, that should be 4080 divided by 4080. Okay, divided by 4080. Okay, so this calculator of mine is misbehaving again. So we are having something like 3000. Let me just do this. 3950 divided by 4080. So we're going to have 0.97 times, okay, 0.97, that's current ratio. Okay, and then I mean, for the year 2016, what about 2015? What was it like for 2015? We go back to the question. There we do the sum again. That's, we have got 1.800 plus 1.250 plus 480. You get of 3530 divided by 2800. Okay, so that's 1.26. 1.26 times. Okay, 1.6 times. Then the quick ratio. Okay. Okay, I'm sure we are aware how these or what this means. Okay, this ratio. Okay, usually, like I said, the current ratio is current assets over current liabilities. What it means is this is 1:2, or 0.97 of assets is to $1 of liability. Okay, $1 of liabilities. Okay, so like in this case, we've got 1.26 of assets is to $1 of liability. So it's $1.26 of assets. $1 is equivalent to $1. I mean, is in relation to $1. So what it means is, in this case, we are having a more favorable position where we are having more assets as compared to liabilities. Okay, in this case, there are lesser assets as compared to liabilities, because we are having $1 of liability being matched to a 0.97 of assets. All right, so this is not a favorable position. We expect this ratio to be 1 and above. Okay, so in this case, we are going to fail to meet the current liability obligation, whereas in this case, we are in a position to meet the current liability obligation. Okay, so that's the trick about this ratio, right? Some prefer it to just put it as 0.97 as to a liability, or simply just put 0.97. But what this 0.97 will mean is that we have got a 0.97 ability to meet our current liability obligation, which means that we have got more current liabilities as compared to current assets. Okay, that's it for now. Like I always say, if you are getting this video helpful, please don't forget to subscribe. Okay, I'm taking as much time as possible to ensure that I don't just rush things and finish the video. By the end of the day, you need to benefit from watching the video other than just to have your time being wasted. All right, so if you find it helpful, just don't forget to subscribe. Don't forget to click the notification bell for the next video, which I'll upload almost on a frequent basis. Okay, so that's the current ratio. The quick ratio now, this one, we are saying that current assets minus inventories in bracket divided by the current liabilities. So we are saying that how much, to what extent can our more liquid assets are able to pay our current liabilities? How liquid are we in terms of paying our current liabilities? So that's total current assets, okay, minus inventory divided by current liabilities. So we're going to just to ignore the inventory balance as we calculate our current assets as normal. If we go to the question here, we are going to exclude this figure. Okay, we're going to exclude this figure. So we are going to work with this one, this combination alone. This combination alone. We are going to ignore inventories. Okay, so in 2016 we are having 1590, okay, divided by 4080. So we are going to have 0.39 in 2016, 0.39, whereas in 2015 we were having how much? We're having that's 1250 plus 480, that's 630 divided by 2800. Okay, 2800. That's 0.23. Okay, now let's do the inventory days. Inventory days, this one we are saying the inventory divided by the cost of sales. Okay, inventory divided by cost of sales. So how much was the inventory in 2016? 2016 the inventory was, let me just rub off this. Okay, the inventory 2016 was this one, 23660 divided by cost of sales. That here the cost of sales, this one 15840. Okay, multiply by 365. We're having 54 days, 54.4 days. So that's 54 days. Then in 20x5 we're having inventory 1.80. 1.800 divided by cost of sales 14,015. Okay, multiply by 365. We are having 47 days. Lastly, the inventory turnover. This one is cost of sales divided by inventory. Cost of sales divided by inventory. Okay. Cost of sales divided by inventory. The cost of sales was 15,840 divided by 2360. So that's 6.71 times. 6.71 times. Okay, the rate at which inventory is being turned up is 6.71 times. What about in 2015? In 2015, we were having 14,015 divided by 1.800. Okay, 2015 was 7.79 times. Okay. Now, using this information, you can see that you can create, you can come up with odd risks so that you ace this particular exam with easy, okay, with all the easy in this world. All right. For example, the GP margin. Okay, let's talk about this. You can see that in 20x5 the GP margin was 33.83%, but in 20x6 it had increased to 37.2%. So how much was the increase? Let us work out the increase. The increase there should be 37.2 minus 33.83. So there was almost a 4% increase. Okay, it was 3.37 increase. Okay, so we're having here, this is 3.37 increase. Okay, in GP. What about increase in operating margin? Operating margin is not increased but is falling. This is a fall. This is an increase. Okay. Given such a situation, you can see that there could be some misclassification of costs. Okay, there could be some misclassification of costs where certain costs have been misallocated to the operating expenses when they should have been as part of cost of sales. Okay, so the cost of sales, seems that the cost of sales has been reduced to an extent that our GP margin has increased versus a falling operating margin. So it means that maybe the operating expenses have been overstated, whereas the cost of sales are understated. So that's the misclassification of costs. Okay. Now, let's talk something in relation to the inventories. In relation to the inventories, because in our last paragraph we're reading about the issue to do with a certain line of products which had 90 days. In addition, the audit assistant noted there were some lines of inventory which, according to the records, were at least 90 days old. Okay? 90 days old. Now, let's try to create some audit risk from this information, okay? Given the computations which we've just made in relation to inventory. Okay, we can see that here the inventory days had increased from 47 to 54, which is about an addition of 7 more days. So which means that we might be having some slow moving inventories within us. And that could also indicate that the inventory values could be overstated, as slow moving inventory is an indicator that there might be some items of inventory which are absolute, or which would be absolute as a result of that. Okay, so there is a high risk. You tell the examiners that. Okay, let us just create a good point there. Okay, so before I just go past this stage, I'm sure you have now, you have seen how we calculate these ratios, and you might be lucky to come into an exam and see these ratios. They are always there, and they are worth good marks. Okay, but you have to make sure that you use your calculator to come up with these correct figures, both the GP margin itself. You should be able to come up with the name of the ratio and compute the correct the correct ratio for both the years. Okay, so come up with the good and correct figures and the name of the ratio. Then you get your 1 mark. You do the next, get your 1 mark, 1 mark, 1 mark, 1 mark. So you can see that just have to have the knowledge about these ratios so that you pass this next exam. Do not fail. Just replay this audio, how you come up with these, and how their variables are cast. Okay, the variables I simply mean the formulas. Okay, the items included in the formulas of these ratios. For example, we say that inventory turnover, we are saying this is cost of sales over the inventory itself. Okay, just as that. Okay, as simple as that. For the inventory days, we say that this is the inventory over cost of sales. So you can see that this is almost an inverse of this ratio in terms of the variables, although we do not put the 365 days here. When we are talking of the inventory days, we are simply saying that this is inventory, okay, inventory over cost of sales multiplied by 365. Do not be confused. The quick ratio, we said this is current assets minus inventory. Okay, current assets, all current assets minus inventory divided by current liabilities. And this one, we said this is current assets over current liabilities. Payable days, we say that you have to say payable, the trade payables over cost of sales multiplied by 365. You go here, you come here, the receivable days, that receivables themselves, trade receivables over revenue, over sales multiplied by 365. GP margin, that's gross profit over revenue or over sales multiplied by 100%. This one applied by 100%, but OP margin, operating profit margin, okay, operating profit divided by revenue multiply by 100%. Sometimes operating profit, sometimes the examiner might put profit before interest and tax. Do not be confused. It's still the same. I'm sure we are helped with regards to these ratios. Let's move on, because I just want to explain the purpose of the video was how you mustn't panic, okay? But you have to make use of these ratios and be able to infer, okay? You just have to be able to infer how they relate to audit risk, okay? Here we have seen, we want to discuss about this increase in 7 days. What is its significance in relation to audit risk, okay? We are told that during the interim audit, okay, this guy, the audit assistant, noted that there were some lines of inventory which, according to the records, were at least 90 days old. But with this only information, this is not an indicator of anything. It says nothing. Okay, this one says nothing unless supported by other evidence. We need to create the evidence, and this is why we had to calculate a ratio. Okay, and the ratio has told us that, hey, in terms of inventory days, they have got now they've increased their inventory holding times. Okay, the days have increased from 47 to 54. So there is now a risk. What is the risk? The risk is that there could be some other items of inventory which are overvalued. Overvalued in what sense? They are now slow-moving inventories. They might be obsolete. They might be obsolete. Okay, they might be obsolete during the time we value them. Okay, we could just assume that they are still having, they are still being valued with an NRV which is below cost. Okay, the NRV, when the NRV itself is now, because we say that inventory is valued at the lower of cost and NRV. Okay, but in this case we are still valuing the inventory at the cost, when in fact its NRV is now below the cost. So which means that cost is now higher than the NRV, and the inventories in stock are still being valued at that original cost, when in fact they should be valued at the NRV, which is now below the cost. Are we together? So we need to write this point as clear as possible so that the examiner is going to award you our 1 mark. Otherwise, if we do not create it as clear as possible, we are not going to earn anything. We are going to get a 0. Simply saying that the audit assistant has seen that there is an item of there are items of inventories which are 90 days old, then don't expect that you get any mark out of that. There is no mark, but you have to relate it to a particular ratio. Okay, so let's talk about it. Okay. During the audit, the interim audit, certain items of inventory were found to be 90 days old. Given the fact that the inventory days had has increased from 47 to 54 days. There could be some slow moving stock. Okay, slow moving stock. So what? You're not through. You're not yet through. Tell the examiner. So what? Okay. There is a risk that obsolete inventory has not been written down. And inventory is overstated. You may go further and say, in terms of IS2 inventories, inventory is valued at the lower of cost and NRV. So the danger of this case is that the NRV could now be lower than the cost. Okay, and the inventory is being valued at the cost, when in actual fact it should be valued at NRV, as its NRV is depleted, has fallen down. All right. So what do we have to do as auditors now? We've highlighted all these for 1 mark. So what do we have to do? What is our response? What shall we do as auditors? Okay, so what we need to do is to obtain the aged inventory report and review it. Okay, and review it to assess if there are slow moving stock. You may consider discuss with management. Okay, discuss with management those particular items you feel are slow moving. Okay. Discuss with management about those particular items you feel are slow moving, and agree that they have been considered for NRV testing. Okay, they have been considered for okay, cost and NRV testing. Okay, cost and NRV testing. Okay, that's the first thing we might want to do. We discuss with management after we obtain the aged inventory report or analysis report. Okay, aged inventory report. Then when we see that there are some items which are slow moving, we discuss with management about those items and have them considered for a detailed cost and NRV testing. Okay, this would help us assess if an allowance or write down of event is required. Sometimes it's not required, so we only have to recommend or to instruct managers to write down inventory only after a detailed cost and NRV testing exercise has been done. Otherwise, such a recommendation would not be valid. Okay. Okay, now we come to a very interesting paragraph. Okay, Centipede Co has a head office where the audit team will be based to conduct the final audit field work. However, there are 4 additional sites where some accounting records are maintained, and these sites were not visited during the interim audit. The records for these sites are incorporated monthly through an interface to the general ledger. A 5th site was closed down in 20X5. However, the building was only sold in 20X6 at a loss of 825,000. So in this paragraph, we've got the issue of the accounting interface, okay, and also the issue of asset disposal. All right. So we're going to create at least 2 audits from this paragraph. Okay, at least 2 audits from this paragraph. So the first one, there is an issue, okay, where we are having a head office. Okay, simply the head office where the audit team will be based. Fine. When they will be conducting a final audit fieldwork. However, there are also 4 additional sites where some accounting records are maintained, and these sites were not visited during the interim audit. So it's now up to us to consider whether we visited them or not. But during the interim audit, those sites were not visited. All right. So these records, the records for these sites are incorporated monthly through an interface to the general ledger. So the issue of interface, we are talking about some computer system here, right? That's some issue of computer software, all right? That will be like we'll be updating on a monthly basis. Whatever that is happening to those sites will be updating to our main general ledger system, all right? So what's the audit risk there? Okay, we need to highlight to the examiner that Centipede Co maintains accounting records at 4 additional sites whose info is incorporated into our GL on a monthly basis. Remember, risk identification from the scenario is just a copy and paste issue, okay? And you only you only get a 0.5 mark for that, just to identify. But then you have to explain for another 0.5 mark so that you get a complete 1 mark. All right. Incorporated into our, yes, my writing, which is incorporated into our GL on a monthly basis. Okay. There is a risk. Okay. These sites are not visited. Were not visited during the interim audit. Okay, were not visited during the interim audit. Okay, there is detection risk if auditors don't visit, if auditors do not visit the sites. Okay, if we do not visit the sites, if we do not visit the sites or some of them, okay, some of them, we need to go and check what is going there. Okay, we need to go and see what's going on there. All right. In addition, there might be errors during the interface transfer of files from these sites. Okay. In addition, there might be errors during the interface transfer of files from these sites if the system was having challenges. So what do we have to do? Okay. What we have to do is very simple. The first thing, because we've identified that if we do not visit these sites, there is an issue of detection risk, okay? Because there could be something going on their bed which needs to be checked. All right. So about the visiting issue, we need to consider visiting. So Antico should consider visiting some of the sites. Consider visiting some of the sites, okay? Why or when? Depending on their materiality. okay, on their materiality in terms of accounting information held, okay, for what? For the assessment, for the assessment of the records held and Co should consider visiting some of the sites depending on their materiality in terms of accounting information held for the purpose of assessing of those records, for the assessment of the records which these offices are holding, okay? But we don't just go to whatever office. We need to first consider the materiality, because by the end of the day, as auditors, we need to assess materiality before we make a decision. Okay? Now, what about the issue to do with the errors during the transfer of file, or during how sure are we that the general ledger interface, the general ledger interface or transfer of file is not going to be with errors? How are we going to be assured that the system, the client system, is operating as it should be? Remember, this is now, we have been taken now to a computer environment, okay? A computerized environment where we need to do some computer assisted auditing techniques. So we need to employ cards. And Co should consider utilizing computer assisted auditing techniques cards to verify if the client interface is operating as it should. Okay, this can be done by sample testing, each monthly interface to see if there were no errors during transfer of files. Okay, so you can see that you can lead yourself just from reading the issue, understanding what it is talking about, and then you slot in appropriate and practical solutions. You identify the problem, that's the risk, but then you have to also come up with the solution. So we are being tested to be very business thinkers, be very assertive, at the same time to bring up solutions. Don't just pinpoint problems without giving solutions. identify the problem, give us the solution. All right, I think here I'm going to discuss the last risk before we do the last part. Remember, the purpose of the video was just for us to see where and how we are going to come up with the identification of the risk, its explanation. All right. Okay. If we go back to the question, there was we talked about the first part. Okay, we talked about the first part, which deals with the computer side, the interface and so forth. Okay, but now there is this last segment of the paragraph which talks about the disposal of the building. Okay, a fifth site was closed down in 20x5. However, the building was only sold in 20x6 at a loss of 825. So during the year, we disposed of a building at a loss. Okay, so what's the audit risk there? Okay, remember, audit risk should be material. Okay, we are given a figure here. We should think of the materiality of the figure. Okay, we have got this acronym which you have to be used to whenever you think of materiality of an item. We've got the RAP, okay, and we've got RAP. R is got a half, this one is got a 1, and this one is got a 5. Okay, 0.5%, 1%, 5%. RAP stands for revenue, A stands for assets, P stands for the profit before tax. Okay, now if the item is about 0.5% of revenue, 0.5%, that is 0.5%, is different from 50%. We're not talking of half of revenue being half of revenue. No, we're just saying 0.5% of revenue, not 50% of revenue. All right. So we need to calculate the materiality of this figure, 825,000. Okay, divided by, we go to our table, we are given the information here, over 25 million. Let us use our calculators. 825,000 divided by 25,230. Okay, 0, 0, 0. That's how much? 0. That's 3%. 3.3% of revenue. 3.3% of revenue, which means the item is more than how much? It's more than 0.5% of revenue. So that's, therefore, it's material. The item is material. So that's the loss of this figure. Of this asset. It was sold at a loss of 825,000, and 825,000 is 3.3% of revenue. So the item is material. Okay, or the loss is material to the financial statements as a whole. All right. So the transaction is a material transaction. We cannot ignore it. We have to talk something about it. So what's the audit risk there? The audit risk here is, okay, let us first identify during the year. Okay, the client, that's Centipede or Centipede, sold a building for 825,000. Loss for 825,000 loss, okay, or at a loss of 825,000. This is a okay. Let me just say at 3.3% of revenue. The loss is material. Okay, the loss is material. The first risk attached to this transaction is there is a risk that the loss, not the loss itself, there is a risk that the disposal of the asset itself is not being accounted for. Okay, in the accounting records. Okay, in the accounting records. And that the it's my computer, and that the loss and that the loss on disposal is not being correctly computed or calculated. These are the risks. Okay, why could they, the examiner might be interested, but why do you think they could not have accounted for the disposal as well as the loss? Okay, there is a motivation, remember, because these guys are a listed company. Okay, the disposal of the the disposal of the asset might have some bearing. Okay, the disposal of the asset might have some bearing, especially at a loss. Okay, having a loss or recognizing a loss has got some negative impact on our profitability as well as the share price effect. Okay, so we might be tempted not to remove the disposal at all from our non-current assets. We might not recognize the disposal, or we might just give a blind eye to the transaction. Or there is also an inference that the computation of the loss on disposal was not properly done. So those are the risks which we have highlighted here, that it's either they did not remove the asset from other assets, they did not remove this disposal from other assets or from the accounting records, as well as they might have made an error in the computation of the loss on disposal. So what do we have to do as auditors now? Okay, the first thing we have to do is to make sure that the asset has been removed from the asset register. Okay, the asset has been removed from the asset register. So we have to agree. Okay, agree that the asset has been removed from asset register. That's the first thing we have to do, given the information. And then we have to recalculate the loss on disposal for accuracy. Okay, and what do we have to do? Agree every figure in this computation. Okay, agree every figure to supporting documentation. To supporting documentation. All right, that's the first part about this building. Okay. Okay. The second part now of this building issue is that the building has been sold at a loss. In a very skeptical auditor's mind, some things could be, coming up. Okay, why did they incur a loss on disposal? This should be an indicator that the depreciation policy is not good, or the depreciation rates are not as good as they should. Okay, they're not that correct given the situation on the ground. The depreciation policy could not be tallying with the type of the asset at hand. Okay, so it means that maybe they are under depreciating their assets. Okay, they are under depreciating their assets, or maybe they are over depreciating their assets. All right, but in this case, it may signal that the depreciation charge which is being put on the assets is very low. Okay, the depreciation charge is very low. All right. So what do we tell the examiners about this point? We say, in addition, because we are still on the building point, okay, in addition, the significant loss on disposal suggests that the entity policy, depreciation policy is not appropriate. Suggest that the entity's depreciation policy on land and building, for example, okay, in this case it's land and building, on land and buildings is not appropriate, because we can't expect a significant loss or some significant profits if we are actually charging a depreciation rate which is of industrial standard. If our depreciation policy is in line with industrial practice and so forth, we do not expect much profit or loss. So it shouldn't be something significant. But in this case, it was very significant. All right. So it means that the entity's depreciation policy could not be appropriate. So what is the risk? The risk is that, as in this case, there is a risk that depreciation of land and buildings is understated. Why am I saying it's understated? Okay, let us just illustrate this fact with actually an example. Let's say our cost of the asset, was 1,000. Okay, the cost of the asset was 1,000, and then accumulated depreciation so far was 600. Okay, this is asset A, and we have got asset B. Okay, the cost and the net book value. The NBV here is 400 bucks. Then we've got asset B. Asset B, the cost is 1,000. Accumulated depreciation for this asset is 800. NBV is 200. Okay. Now we sold this asset, and the proceeds. The proceeds were let's say 500. Let me just say 300. Okay, the proceeds for both were 300. Okay, the proceeds were 300. Here we get how much? Here we get 100 profit. Here we get loss. Okay. You can see that these guys, these assets are of the same class. Okay, they're of the same class. Their costs were the same, number of years, whatever, the same, but the depreciation rate, okay, you can see this one end up having a profit of this one, but this one have a loss. Why? Because they are understating the depreciation charge. They are understating the depreciation charge. In terms of NBVs, you can see that their assets are overstated in terms of assets, in terms of the NBV, okay, the net book values of the asset. You can see that these assets are overstated. But now, the proceeds now give us an indication what the market rates your assets to. You can see that the proceeds of 300, okay, actually give us some indication about our depreciation policy. Okay, so in this case, in our Centipede case, you can see that the depreciation was being understated. So if we understate depreciation, the corresponding effect is that we are overstating assets. So you can also write that there is a risk that depreciation of land and building is understated, while the value of these land and buildings is overstated. I'm sure this example can assist you in understanding what would be going on. Why, if we come to a conclusion that the depreciation charge is understated. Okay, I'm rubbing this off so that we move. Like I said, this was my last risk, okay, and we need to discuss other aspects before we call it a day, okay. But I believe that you guys have been helped, you have been assisted so far, okay. I do believe that you guys have been assisted. So what do we do to ensure that this risk which we have highlighted is minimized? Okay, what do we do? What do we do with the risk? Okay, the issue here is we have to discuss with management. Discuss with management their depreciation policy. For reasonableness, for you to understand how reasonable it is, because you must tell them, we didn't expect this disparity, we didn't expect this difference, but it has been noted. What could be the cause? Why are you having such a depreciation policy? Then they will explain to you. All right? Then, what else? You then have to go a step further and review other asset disposals. Other asset disposals to ascertain whether similar losses have been incurred on disposal. Have been incurred, okay? Have been incurred. Have been incurred to conclude if it is an entity-wide issue. An entity-wide issue. If the depreciation issue is actually an entity-wide issue. Yeah, so I think that's the best response so far. Okay, now, like I said, the purpose of the video is not actually to do everything about the question, but to discuss on how we can come up with reasonable points and convince the examiners of how we are going to attack a particular audit situation. Okay, now let me just try to come back to this particular question. Okay, one of Centipede Co's wholesaler customers alleging that the company has consistently failed to deliver goods in a sellable condition and on time. Hence, it has commenced legal action against Centipede Co for a loss of profits claim. Wow. Okay, without writing, let us just discuss this point. Okay, ladies and gentlemen, this is a provisions question. Okay, the examiner is testing us about our understanding of provisions, contingent liabilities, and contingent assets. That is IAS 37. Okay, IAS 37. So in this case, one of Centipede Co's wholesale customers is alleging that the company has consistently failed to deliver goods in a sellable condition and on time. Hence, it has commenced some legal action against the company. All right. The situation is, you just have to copy and paste this particular. It's actually an audit risk. Okay, you copy and paste, but you need to explain why it is a risk. The first thing, like I have indicated in my answer worksheet, you need to, after pasting the point, okay, the risk, after identifying this whole thing, you just copy and paste it on your answer sheet. Okay, then you then have to explain why or how it is a risk. But in doing so, you need to point out the accounting position. All right, so I think we can just do it quickly. Let me just write what I'm saying here. Okay, one of the customers has commenced legal action. Over the is it about quality? Over the delivery, okay, in sellable condition. Over the delivery in sellable condition. Over the delivery of the goods sold to them. Okay, if this is the accounting part, if it is probable that the client will make payment to this customer. Hey, when I say client here, this is Centipede Co. Okay, that's our client. Okay, but when I'm talking about this customer, that's Centipede is client, not our client. Okay, please Don't be confused there. All right. So if it is possible that the client will make payment to this customer, then a provision has to be recognized. Has to be recognized or is required. Okay, the provision is required or has to be recognized. However, if it is only possible, rather than probable, then a contingent liability has to be disclosed to the notes, in there is to be disclosed in the notes to the FS, financial statements. You haven't talked about the risk. There is a risk that Centipede Co has not done this, has not done this. Suggesting that provisions are not complete and contingent liabilities are not fully disclosed. Are we together, ladies and gentlemen? How am I getting all these points, or where am I getting them from? You just have to identify the risk, okay? Make use of, think of the accounting treatment. Remember, here we are talking of provisions, contingent liabilities, and contingent asset, which is an issue to do with IAS 37. IAS 37. Okay? Tell the examiner, okay, if it is probable that the client is going to pay, then we have to, a provision is required, or we have to create a provision. We have to recognize the provision. But if it is only possible that we are going to pay, to make a payment, then a contingent liability is to be disclosed in the notes to the financial statements. So what then do we have to do as auditors? What then are we going to review this, or how are you going to deal with that risk? Our response should be very practical. Otherwise, if we just regurgitate things, we are going to fail. Okay? Remember, the response should be meant to address the risk. So in this case, a legal action has been instituted, And we know who is responsible for legal things in the company. Obviously, the legal advisors of that particular company should be consulted. So, request in writing. Request in writing. About this case's position from the company's lawyers. To ascertain the likelihood that the company is going to pay their customer is a result of the legal claim. Okay, we have to write to the company's lawyers, okay, requesting the case position. Okay, what is the position? Is the company likely to pay? Okay, make use of the advisors. We're talking of legal advisors. Advisors' response to determine whether to recognize, okay, to determine whether to recognize or disclose, to recognize a provision or disclose a liability. To recognize a provision or disclose a liability is appropriate. Okay, so you can see that this is actually a practical exam. You need to show the examiners that, hey, this is how we are going to do things here. All right, this is the way things should be done. Okay, I'm sure we've discussed about very pertinent issues with regards to the Centipede Co question. Okay, let us just discuss about other things I feel we may need to talk about. Okay, you may also consider the issue of cost classification when you just look at these guys. We have got revenue and cost of sales. The rise of these, they should rise in tandem. They should rise in parallel fashion. If revenue increases, therefore we expect cost of sales to increase, all right, at the same rate. Okay, for example, let us see how revenue increased over the period. Okay, from 21 to 25,000. Let us use our calculators. Let's just try to use our calculators. Okay, that's 25,230 minus 21,180, okay, divided by 21,180. So there was a 19% increase in terms of revenue. Revenue increased by 19%, 19.12%. 19.12%. Okay, that's how revenue increased over the period. Like this, like this, or okay, that's revenue increased by 19.12. What about cost of sales? Cost of sales 15,840 minus 14,015, okay, over 14,015. So you can see that the cost of sales only increased by 13.02. So you can also make these arguments in your analysis. Okay, of course, this is not a ratio, but it's a necessary computation when you want to highlight the point that there was allocation of costs between the cost of sales and the profit, the operating expenses. Okay, because the increase here suggests that there is actually a misallocation. Okay, some of the costs have been excluded from this cost of sales and they have been put to the operating expenses. This is seen in a non-matching increase of revenue and cost of sales, where revenue is increasing much faster than the cost of sales. So that's how you can play around with these figures. Now, the other aspect about liquidity, okay, about liquidity and going concern issues. The going concern issues. You may also, because going concern is also part of our task as auditors to see if the entity is a going concern and so forth. Okay, so if we look at the liquidity, if we go back to our ratios, if they are still legible, sometimes they are now okay, so it's no longer clear. Okay, it's no longer clear, it doesn't matter. Okay, but I'm sure the ratios which we want are still visible. Let me just erase a bit. I hope I won't delete everything. Okay. Okay, we can see that the receivable days is increased, even though it is not much, but there has been some increase in terms of receivable days. Okay, but at the same time, our current ratio is deteriorated from 1.26 to 0.97, which means there is going to be some problem when it comes to the payment of or us honoring our current obligations. Okay, so we are struggling, but it's another point you may highlight that the current ratio is deteriorating, so there is actually a danger that this company is going to fail to satisfy its obligations. You can also support this point by highlighting that their quick ratio is far way below 1, which also suggests that they are actually in a dire state. All right, the inventory turnover is deteriorated, which means they can't actually sell faster than they used to be in the previous year. In the previous years, okay, from 7.79 times to a drop to 6.71 times. So that one is not a good business picture. All right, you can also go to the actual figures without doing any computation. For example, In 20x5 we had some cash balance from 480, and this has dropped to a zero cash balance. Okay, this is not a good picture for a going concern. All right, and our payables have increased from 2.8 to 3.5, and we have sustained an overdraft of 580. Okay, so this one is not actually a good picture, which might also, there should also be some issues to do with the going concern, and coupled with the fact that one of the major customers has threatened us with a legal claim. That also might impact on our reputation as a business, or the reputation of the client as business, which might suggest that this client might not be a going concern in the shortest possible future, in the foreseeable future. All right, so that's it. Ladies and gentlemen, when you are talking of risk, remember, in this case we are talking of the going concern disclosures. The client, there's a risk that the client is not going to appropriately disclose its going concern issues. Okay, it's not going to appropriately disclose its going concern issues, especially concerning its liquidity and the issues to do with business risk, especially the loss of potential customers and so forth. Okay, let us just do the last part of the question. Okay, the last part of the question, which talks about these issues. Okay, it's a very important issue with 5 marks, and we can't let those marks go unpocketed. We can't have that fantasy. So we need to just discuss about that last paragraph, and we call it a day. Okay, and we call it a day. So let's read that paragraph. Okay. Okay. The finance director of Centipede Co informed Ant and Co that one of the reasons they were appointed as auditors was because of their knowledge of the industry. Ant & Co audits a number of other consumer packaged goods companies, including Centipede Co's main rival. We are also auditors of the company's main rival. The finance director has inquired how Ant & Co will keep information obtained during the audit confidential. So the finance director has inquired how we are going to keep information obtained during the audit confidential. So there is an issue of confidentiality. Okay, remember, it's one of the fundamental ethical principles, confidentiality. Okay, we need to respect the client's confidence, means the client's confidentiality. Okay, now required, explain the safeguards which Ant & Co could implement to ensure that this conflict of interest is properly managed. How are we going to ensure that we do not disclose the client's information to the rival, especially? So in this case, there is what is called conflict of interest. There is a conflict of interest issue here. Conflict of interest, where we are auditing our client's competitor. Okay, we are auditing the client's competitor, so we are likely to face some conflict of interest. Okay, and that will compromise our position as auditors. All right, we might our objectivity might be impaired. Okay, so what do we have to do? That's the question. The question is saying that what are you going to do? The first thing is all right, let me just find somewhere to write. Test, we have got some writing space. Seems the space is gone. So what do? I have to erase a bit, just a bit. I'm sorry. Okay, I can even write on this small space. It doesn't matter. It doesn't matter. Okay, let me just use the pen color. Let me change it. Okay, yes, a different color. It's better. Okay, the first thing we have to consider, okay, safeguards. The safeguards possible. The first thing is to come clear to both clients. Okay, inform both clients. Inform both clients that you are the auditors. Okay, and proceed if they consented to it. If they consent, so you have to proceed with the audit work. If they consent, if they agree that you become the auditor of their competitor, okay, but you have to inform them. Come clear. You explain everything to them that, hey guys, I'm your auditor. I'm also the auditor of B or A or C. Okay, are you happy with that? Okay, and if they consent, then you then have to continue with the audit. Okay. Okay, what then do you have to do next? Okay, you may also advise them to seek independent advice. In addition to your explanation, they might consider also to seek some independent advice whether our engagement should continue or not. So you have to advise them that, hey man, you may also consider if it is necessary or if it is feasible for us to continue as auditors, as your auditors, given this particular situation. Okay, you may also use different teams, different engagement teams for each client. Use different engagement teams, which means different operatives, different managers, and different engagement partners. Are we together? You need also to implement procedures which ensures confidentiality, okay, of information. Implement procedures which ensure confidentiality of information. E.g., you might put the teams to task by have them signing confidentiality agreements, ensure that the records of the clients are under physical lock and key. Okay. The records are not going to be physically proximal to one another, okay, or near to one another. They should be kept at separate locations, And even the teams themselves, they can also operate from different locations, different offices. Okay? These engagement teams should be operating from different locations. At the same time, the records of the camera should be kept separate from one another. Records of these clients, they should be kept separate physically from one another. If it can go to an extent of putting security guards on the particular informations, the security, if it can go to that extent, it's fine. Okay, to ensure that no record is going to come nearer to one another between these two clients. Okay, and also ensure that your teams have signed confidentiality agreements. Okay, so we can talk of confidentiality in terms of, for example, location and physical security itself. Physical security of records. Okay, and this one, the examiner wants it alone. Okay, have teams sign confidentiality. Have teams sign confidentiality agreements. Okay, I do not have a space to write. Okay, so have teams sign confidentiality agreements which ensure that they will respect the confidentiality of these clients, because they would to know that if they violate the dictates of those agreements, then they will be risking their jobs. Are we together? Then you might have a senior audit individual in your firm too, who is not involved in either audit, to regularly monitor the application of all these things. Okay, so senior member or senior team, senior official from your firm, senior official from Centipede Co, who is not part of the audit, to see if all these safeguards are being implemented and are running efficiently as they should. Okay, so somebody should be monitoring if there are no any violations of the confidentiality and everything. So you can see that you can come up with as many safeguards as possible. But what is important in the exam is not actually to come and tell the examiner or to show the examiner that you have crammed everything. But after you cram, try to make sure that you have processed the cramming into something that is useful for the purpose of your passing, for the purpose of you getting through this examination. I hope you have been helped. If you like this video, if I have done all the justice that is required to this particular question, Centipede Co, please do not fail, do not ignore to subscribe. Just subscribe and give me a thumbs up to show that I'm doing something, I'm doing it wholeheartedly and well. I will improve with time, I will improve as time goes on. You know, the learning curve effect, I'm sure you are aware of it, that as human beings continue to do the process over and over again, they become so fluent, they become so efficient to an extent that it will be so attractive and good for consumption. So I'll try as much as possible to improve my expediency and everything so that you enjoy these videos as I upload them. Please, may the good Lord bless you again and again.